Hello traders, Gary Wagner here. It is Monday, approximately 12:30 in Honolulu. It is the 21st day of November, and this is the daily report for gold and silver. And what a day we're having. Beginning of the week we have across the board once again. S&P lower, silver lower, gold lower. Currently, we have gold trading off by about $47. As you can see, current print 1676.94, call it 1674. Most importantly, it broke through the critical 702. That was the support level that I had pegged. And 1740, of course, that had vanished a while ago. When you take a look at in terms of percentages in the market itself, that was a move of almost 3%, 2.75% lower. And in silver, 2.38% lower, closing off about 77 cents today. And that is currently trading at 31.58. Now, the first thing that I want to talk about is we in the United States witnessed a utter breakdown or a failure for the Super Committee to be able to come up with some sort of results in terms of deficit reductions. That kicks in an automatic plan, which I believe reduces the deficit over 10 years by about 1.7 trillion, and that begins to kick in. To me, no real surprise that the Super Committee was unable to come to terms, to come to an agreement. What is a surprise, of course, has been how the markets have been reacting, especially in the precious metals markets, especially in the safe haven markets such as gold. Again, flocking to the dollar. And my sentiment is that although this particular news has been bearish to the metals itself because of this move into cash, I believe in the long term, over the course of time, this will be a very bullish factor. But what does that do on a technical basis? Well, you know that I have been kind of torn between two possible counts within the Elliott wave count, and it is clear that once we were unable to break above the 76% range, which was 1830, and in fact began trading lower, that rather than this being an impulse phase, we are still in a correction. The correction in terms of a larger count is we are currently in the C wave. On today's report, we'll talk about the possibilities of how that C wave can terminate, because once the C wave terminates, we will go back into a full-blown bullish impulse phase. Now, traders, what I have done is we're looking at the same chart. This is the chart that we have been using to look at the different Elliott wave counts. But what I have done is I have converted it from a daily into an intraday 360-minute candlestick chart. Now, the reason for doing it is that it will give us more detail and allow us to see the intricacies of the actual count and then the subcount within it. So that if we are currently looking at an A, B, C correction, we can see how that's been subdivided. And when we take a look at that, we would typically get a 1, 2, 3, 4, and a 5 count down, which you see right here. On the upside, we would typically get an A, a B, and a C, which you can see here. And then you can see this last C, of course, as a 1, 2, a full count of 3. That takes us to our current play in the marketplace. We would either get a 3 or a 5 count going down on our final C. The way that a C can get terminated, so to speak, or completed is a better way to put it, is that it's either going to be a truncated. Truncated means that the low will be above this A. It will be a flat, which means you will get equal lows, or what's called a standard zigzag, in which your C would actually go below your A in terms of pricing. Now, in terms of our possible count, and again, realize that as information comes into us, as it's available to us, as we analyze that, it is imperative that we're always on the lookout for any turn or any change within the market. But from what I'm looking at right now, basically we've got 1, 2, and we are currently in wave 3 on an intermediate count of a major count of C. We could then see something like this. And then in terms of where this market will end up in terms of what low will it go to, that's something that we will take a look in terms of different Fibonacci numbers that actually make sense. But as you can see right now, it wouldn't surprise me, I should say, to see this market kind of clip up a little bit. In other words, if we had our 1, our 2, we have this long 3, and then we would get some sort of a 4, and then some sort of a 5. Now, where will those terminate? That's something, as I said, we'll look at some Fibonacci numbers. We'll also look at what's out there in the news. But I can tell you, when looking at fundamental information in the news, that has been stifling, because typically these types of moves would bring investors into safe haven investments. Safe haven investments, being gold, would be bullish on the metals, and you would see the market move in a upward manner. However, you've had this flock to the dollar. Why? Well, the dollar is still the strongest of all the currencies out there. When you compare it to the euro, of course, you're going to have a huge distinction there, but there's issues in the European Union. There are also some fairly major issues in the United States, but the United States is a single sovereign country, and although there is bickering amongst the members of the House, it already is unified. And so you don't get that push-pull that you get when you have a union of 27 sovereign nations. That's quite different. So traders, as we take a look at gold, how do we think we will see silver fare along with that? Now, currently trading 31.61. As I said, I still think gold has the ability to head a little bit lower here, although we've had a pretty long wave 3 off of this corrective final C wave in our major count. But in terms of where we could look to find support in the silver market, we're looking at a basic daily chart in silver. The one thing that you'll see is that we are currently below this 76% level. That's 31.90. And we are currently trading at 31.60. 31.61 is a 76% retracement. And that retracement is from this last move down. What I mean by last move down, from $44 as the market went from 44 down to 25.97 as it came back up. We look at the different levels of retracement, and you have 76 down here at 30.23, but from this retracement here, you're at 76%, which is 31.51. So what we're looking at is different levels of retracement. This is the much larger level of retracement, and this is back from the move in February. Silver at 26 moves all the way up to almost 50, call it 49.68. And as it comes down, the different various retracement levels, the big one, of course, is this one, 31.51. That is a, excuse me, traders, a 76% retracement of that move, and then the shorter move, 30.23, is right here. So those are the two real important numbers to watch. We have obviously traded below the first of the two, which is 31.90. That's the larger retracement. So the next target area that we want to pay some real attention to is going to be 30.23. 30.23. And then we're going to have to really see how the market reacts at that point. There can be no doubt that we could see protracted pressure within this market. We'll see if it sold off pretty hard. So we'll see if it found some sort of a bottom, and then we will take it from there. Traders, we are looking at a weekly chart of the dollar index. And as you can see, although it's only the first day of the week here in the States, you can see that this market has traded higher. These are the last 3 weeks of trading activity in which we have seen the dollar move higher against a basket of 6 foreign currencies. And where we find any kind of resistance, we're currently at 78.46. We don't really have any strong resistance on a technical basis till about 79. And of course, you've got this star, this Three River Evening Star that signaled the top, but that top came at about 80.5. So those are the real strong areas that we want to look at on a technical basis in terms of where the dollar itself could begin to wane a bit. This has been Gary Wagner, wishing you as always good trading. We'll talk to you tomorrow for another daily update and review. Bye-bye.